Hello everyone, I'm Tarnu Mansoori, second year MMS student of SciS Institute of Management Studies. I'm going to present on the topic of types of financial model. Now, we have the introductions of financial model. A financial model is a mathematical representation of financial operations, a financial statement of the company. It is used to forecast future financial performance of the company by making relevant assumptions of how the company would fare in the coming financial year. It is a risk management tool for analyzing various financial and economic scenarios and also provided valuations of assets. This model involves calculations, analyzing them, and then providing recommendations based on the information gathered. Now we have the types of financial model. There are the six types of financial model. First one, comparative company analysis model. Second, discounting cash flow model. Third, leverage buyout model. Fourth, sum of the part model. Fifth, merger and acquisition model. And the last one is option pricing model. The first one is discounting cash flow model. DCF is based upon the theory that the value of business it is the sum of is expected future free cash flows discounted at an appropriate growth rate. Investors particularly use this method in order to evaluate the potentials of an investment and estimate the absolute value of the company. The second one is merger and acquisition model. In which the first point is the entire objectives of the merger modeling is to show the client the impact of an acquisitions to the acquired EPS and how the new EPS compares with the status quo. In simple words, we could say if the new EPS is higher, these transactions will be called acquisitive, while the opposite will be called dilutive. The third one is comparative company analysis model, also referred to as comparable ABD comps. It is one of the major company valuation analysis that is used in the investment banking industry. In this method, we undertake a peer group analysis under which we compare the financial metrics of a company against similar firms in industry. Now we have the leverage buyout model, in which the first point is leverage buyout deal involves acquiring another company using a significant amount of borrowed fund to meet the acquisition's cost. Second point is this kind of model is being used majority in leveraged finance at bulge bracket investment banks and sponsors like a private equity firms who wants to acquire companies with an objectives of selling them in the future at a profit. Now we have the option pricing model. Option traders tend to utilize different options price model to set a current theoretical value. Option price model use certain fixed non in the present and also forecast for factors like implied volatility to compute the theoretical value for a specific options at a certain point in time. The last one is sum of the parts model. It is also referred to as the breakup analysis. This model involves valuations of a company by determining the value of its divisions if they were broken down and spun off or they were acquired by the another company. Thank you so much everyone for watching my video.